how did you take the CPI data? What does it mean for a portfolio of investments that you've crafted over the over the recent months?
Good morning, and first of all, happy Valentine's to you and to Jennifer. Yesterday was not a surprise to us, and I've said it several times on this stage. Inflation that high never comes in one cycle. There are always several cycles that follow, particularly in the US. Yesterday was a punch. It's a convexity punch. If you look at the majority of the players, they were caught wrong-footed. They were long soft landing, short convexity. And this translates into long the MAG4, short spreads, short equity volatility, short rates volatility, short US dollar. And this is what happens. You get caught wrong-footed. Thankfully, we aren't positioned like that. We're away from US equities, and we're positioned in a completely different way. We are ready for a hard landing rather than a soft landing.
All right, so Ryan, dig into that. I mean, how then are you positioning if you are sort of positioned more towards a hard landing, which is sort of counter to what a lot of the market is really anticipating?
Absolutely. So we've replaced U.S. equities with Brazilian equities. Brazilian equities have done 29% in our portfolio last year. If you look at the trade surplus in Brazil, it has been positive $98 billion last year, very positive for the real. So it has delivered beautifully. We're talking about a PE of 5 to 7. We're talking about a basket of companies that are paying us 15% dividends. Another replacement has been Japan, which has done very well for us. So again, we've been contrarian on that front. The Japanese yen is 40% devalued compared to the US dollar on a PPP basis. There is upside there, and we continue to be positioned there. There's also India. India is the new China. So just over the past 4 months, we've done 9% of our Indian portfolio.
Yeah, I mean, are you taking a little bit of profit on Brazil now and perhaps putting that to use somewhere else? And also, I see that China is, a little bit interesting to you, but only in select names.
Absolutely. So we've taken some profits on our Japanese equities and Brazilian, and we started in a very shy and very careful way to enter the Chinese market again. Some names they're literally in the floor today.
Yeah.
It's a complete bloodbath there. So it makes sense to go in again, even if there's another 5 to 7% drop. The upside is absolutely huge if the Chinese government announces anything.
Ryan, a lot of people are watching this CPI print and taking it negatively necessarily, but are you saying that there may be a silver lining for investors looking at this story?
Well, the CPI story is not yet over in the US. And there's a problem in the US today, and it's top down. You have Mrs. Yellen on the Treasury side who's spending a lot of money, which is against the fight of inflation. And you have the Fed that is trying to fight inflation. So the silver lining is basically for day traders. So day traders have a lot of money to make in that volatility, in that whipsaw. However, for institutional investors, long-term investors, fundamental investors like us, we prefer to stay away. The silver lining might be other than in the US, and there are many, many alternatives today. So we moved from TINA, there is no alternative, to many alternatives today to invest in.
What about this region, the GCC region? What's interesting to you here?
So 2023, Abu Dhabi Exchange has been the #2 in the world in amounts raised through IPOs. There has been fantastic IPOs and a lot of money to be made. Some of them have dropped up after the IPO, so timing is very, very important. The region is pegged to the dollar, as you know, so they're not affected by the swings on the dollar. They have positive budgets. The countries are growing, so it's really positive momentum all across. So we are exposed to the region as well in small proportions of our portfolios. Our portfolios are more global, but from an emerging market perspective, the region is strategic for us.
Ryan, is that the same when you look at oil? Because, we're also still seeing a bit of volatility there, but still trading within this narrow range that we've been speaking about over the past few weeks. Is that something that you're looking to or you're staying away from?
We're still bullish oil. on two fronts. The first one is on the supply side. There is not enough replacement capex being put to replace the wells that are getting depleted, not enough infrastructure spending, upstream and downstream for that matter. So we do believe there will be a shortage at some point, and especially if China comes back into the picture. If China comes back, we have a snap up of oil prices. So we continue to be bullish on oil prices for now, until we see what happens with the U.S. Economic growth, whether we have a hard landing and a hard recession or not.
Do you have to reconsider if we, get something unexpected? I mean, yesterday we got CPI that was perhaps the market at least wasn't expecting it, but if we get more or fewer rate cuts than the market's looking at right now?
The big unexpected for us is geopolitical risk. For
Yes.
the first time in my career, 25 years, that I see so much correlation, positive correlation across geopolitical risks. So if, God forbid, something happens between US and Iran, the possibility of something happening between North Korea and South Korea, China and Taiwan is very high. So this positive correlation in geopolitical risk is the big and unexpected for us that we're watching. So this is the black swan, if you will.
Well, it would be a very, very small tail risk, right?
Yeah.
All right, Ryan, thank you so much for joining us today. Much appreciated.